Hi, I'm Jimmy. In this video, we're looking at one of the three major financial statements, and that is the income statement. So throughout this video, we're going to look at the most important numbers. What are they? What are the most important numbers? How do you use them? How can you use this information to pick better companies? How can you use the same information to spot red flags within that company? And ultimately, how does this lead to picking companies that are in fact undervalued? Now, we're going to use two different companies as our examples, and we're going to kind of compare them side by side. And that is going to be Walmart and Target. Okay, now let's look at the very, very basics of what an income statement is. So basically, the income statement tracks both revenue and expenses. If you take revenue and then you subtract expenses, what is left is the profit, also known as net income. By the way, you might also hear revenue called sales. But this right here is actually the most basic formula for the income statement. Revenue minus expenses equals net income. Now, generally, when we're looking at an income statement, it would actually appear a bit more like this. Now, for me, there's a lot going on here, but this is the exact formula we just looked at. Now, the first thing I'd point out is pay attention to in which direction the numbers are going. Sometimes, for some reason, sometimes they go left to right, sometimes they go right to left. In our case, they're going left to right. So just be aware of where the most recent numbers actually are. But this is it's the simple formula we just looked at. Basically, you start with revenue and you work your way right down to net income. It's really as simple as that. If we would eliminate all the other lines and we were to just look at the most basic numbers, the top line and the bottom line, well, basically it's revenue minus expenses equals net income. That's one way to look at it, but we actually have a slightly better way. I think it's a bit easier to track. It's a bit more visually appealing. And now we're going to jump into our first example in Walmart. So this is a flow of funds. Now, by the way, this is coming from the Investors Grow website. If you're curious to sign up there, link in the description below. They call this a single step income statement. You start with revenue, you take one step all the way down to profit, also known as net income. Now, what's interesting here is when you start comparing this to other companies. So you have a company like Walmart here. We can see from the revenue side, they generated about $650 billion in revenue. But for profit, they generated just over 2% of that $650 billion was converted into profit. So you got a profit margin of about 2.4%, which is actually quite low. But they're in a highly competitive industry. What if we were to compare that to a company like, let's say, Target, which is in a very similar industry? And right away, we can see that their net income is 3.9%. So Target has better profit margins than Walmart has. If we know nothing else, this very simple look tells us that. But of course, when we clump all the expenses together like that, it's a bit tougher to see some of the nuances in a company. So again, instead of using the classic table format, we could always use this if we want. It's the exact same numbers. We're just presenting it a little bit differently. I think it's simpler if we look at it through a flow of funds chart. So this is Walmart breaking out their revenue into different functions. So you put all the cost of goods sold together, you put all of the depreciation together, things like that. We're going to walk through each step. So first glance, this is what Walmart's entire flow of funds looks like. This is what Target's look like. But for now, let's start with Walmart, and we're going to just go step by step so we can see what each node looks like, what each step along the process looks like until we get to profit. Okay, so a lot of us know Walmart, and Walmart sells goods. So let's pretend they're selling shirts, and they're going to sell a shirt for, let's say, $100 just to keep the math simple. Well, that $100 gets recorded in revenue. But now the point of the income statement is to break down where that $100 was generated. What did it cost to buy the product? What did it cost all along the way to get to whatever our profit is on, let's say, the $100 shirt? Well, the first step is cost of revenue. You might also hear this called cost of goods sold. And we can see with Walmart, about 75% of all of their costs, all of the revenue that was generated, 75% of it. So in our example, of the $100, $75, give or take, went out the window at cost of goods sold. Then on the gross profit side, which is right below it, well, we can see they have a bit under $25. So that same $100, you can see 75 of it goes up as an expense. the other 25 goes down as gross profit. That's the profit before all the rest of the expenses. Now, this is real important if you think about it from how the company competes in their industry. Many people who know Walmart know that Walmart tends to be, they tend to sell their products for less than many of the competitors. You can see that here in their numbers. Their cost of goods sold is so high relative to their revenue. To illustrate that, what if they sold that very same shirt that we are in our example? Instead of selling it for 100, they sold it for 110. Well, it doesn't cost them anymore, so their cost of goods sold would stay the same. But that additional $10 would travel down to gross profit, and just like that, they would become more profitable. But again, because they're trying to compete and offer products at the lowest possible price, their numbers end up much lower. Now, jumping over to Target, a close competitor of Walmart, well, we can see right away their gross profit margins are 27%. In the most recent fiscal year for both of these companies, we can see that Target has a larger gross profit margin. Target is clearly selling theirs for at least a few percentage points higher than what Walmart is selling. Okay, now jumping back to the full flow of funds chart. Well, now we're back on Walmart, and we're going to run Walmart through right on to the end so we can see how it all plays out, and then we'll compare the entire picture to Target's entire picture, and I'll show you how we can use this to determine fair value. Okay, now we saw with Walmart's 650 or so billion in revenue that they generated, about 157 billion remains in gross profit. Where does that $157 billion go? Well, we can see about 130 billion goes to operating expenses. Now, this whole section up here, all of that is tied to operating expenses. So operating expenses gets further broken down into things like SG&A, which is short for selling, general, and administrative, depreciation, amortization. Then we have something like research and development. Now, Walmart, interestingly, doesn't list for the last fiscal year, doesn't list research and development, so we don't see it on this chart. But if we were to look at a company like, let's say, Google or Alphabet, I suppose, if we were to pull up a chart of Alphabet, this is a history of their research and development over the past 10 years. Clearly, that makes sense given what we know about Alphabet's business. So if we're analyzing a company and we want to see the history, well, on the Investors Grow website, we can click on the little icon that shows the chart. Boom, just like that, the chart will pop up and give us a history of it. Well, if that company is in a highly competitive industry that needs let's say, a technological competitive advantage, having increasing research and development as revenue grows makes a lot of sense. Perhaps in a well-developed business like Walmart, it doesn't matter nearly as much. Then you might have something called other operating expenses. That could include things like restructuring, or perhaps if there was litigation, if there was, they were getting sued for something and they had to pay out fines, something like that. A lot of times that could fall in this category. It might fall, many times it'll fall further down the income statement, but I just want to bring that out. If you see unusually large numbers when you're looking at an income statement, dig into what it is. Once again, on the income statement itself within their financial reports, they're going to show you. But again, this will give you a broad look at it. I just wanted to bring up research and development and the potential of other operating expenses. Those are two big ones that Walmart doesn't have, but many companies will. So one of the first items under operating expenses is selling, general, and administrative, SG&A for short. Selling, general, and administrative is exactly what it sounds like. What does it cost to sell the product? All the cashiers that work at Walmart, the store managers, the people that are loading up the shelves, things like that, all of that falls under selling, general, and administrative. Well, then you have an expense like depreciation and amortization. Now, this one's a little bit unusual because it's not a cash outlay. It is not actually an expense, but it is very important. So let's imagine that Walmart buys a forklift. They're going to buy a forklift to move their goods around their store. They buy a forklift, and let's pretend they pay $10,000, right? They pay $10,000 for this forklift. They pay out that $10,000 in cash up front. But the forklift, let's say, is going to last 10 years, right? They call that the life of the asset. So the life of the asset, 10 years, is what this forklift is going to last. Well, in theory, if it cost them $10,000 and it's going to last 10 years, $1,000 would hit depreciation. The value of that forklift each year would go down by $1,000. That is why depreciation and amortization it's very important from the standpoint of, although it's not laying out cash, it is giving us an idea of how fast their assets are being reduced each year. The assets is something you'll find on the balance sheet. So it is an important number to pay attention to, but I think it's not generally one of those numbers that people spend too much time with. Now, if this number was abnormally large relative to its competitors, well, that could be, or even abnormally small, well, that could be a way for a company like Walmart. Let's pretend Walmart said, you know what, our forklift doesn't last 10 years. Our forklifts will last 100 years. Well, now the depreciation expense gets real small. And because it's real small, what happens? Makes their profit look bigger. So you usually want to compare what percentage of revenue is depreciation compared to what percentage of revenue is, the depreciation for another company. You can compare them side by side, could give you some interesting red flags to be aware of. Now, all of those expenses land at the same step as operating income. Operating income, in this case, in Walmart's case, is just 4.2% of revenue. So of the $600 or so billion that they brought in, they're down to just over 4% of that when they get to operating income. Then the next one we see here is interest expense. So this comes in at just 0.4%, but in the case of Walmart, that's 0.4% of revenue, but it is a bit over $2 billion. This is the interest that they pay on their debt. So if you were interested in buying, let's say, the bond from a company like Walmart, well, the number one question that we would ask early out of the gate when we're doing our research is, can they afford to pay their interest? If I buy a bond, that is who they're paying. They're paying their bondholders that interest. Or maybe, if they got loans from a bank or something like that, that would fall into that category. So that interest expense, in this case, it's less than 1% of revenue. Walmart clearly has enough money to do it. But if they took on a lot more debt, that interest expense would go up and they would become a little less profitable. And this is, again, we'll compare this to Target in a second, but this is a great place to stop and pause and look at, okay, how is the company, basically the green line, how is it flowing through time? We want it to be wider as we get further along. Generally, the wider it is, the higher the profit margins. The higher the profit margins, generally, the better the valuation at the end of the day. More investors are willing to pay a higher valuation when they have better profit margins. But we'll come back to that in a minute. Okay, then the final one down here, it's real small. You can hardly even see the green line, but that is interest income. So just like we just had interest expense, Walmart has cash on hand. That cash might own treasuries. It might own bonds. It might just be sitting in, some money market account collecting interest. Well, this interest income is sort of like additional revenue, the interest that they generate on the cash that they have. Now, in the case of Walmart, it's less than 0.1% of revenue, but it is important to pay attention to. And you might have some companies like, think of an Apple or a Microsoft, which have lots of cash, might be generating meaningful amounts of interest income. Okay, now we're coming to the end here. So now we're at income before tax. Now, before you get to income before tax, there are some other items that are not on here because these are the most standard, most popular ones. These are the most important ones, but sometimes you can have some kind of unusual ones. Let's say foreign exchange rate. If there's a gain or a loss there, that could affect things. If there's one-off items maybe gains or losses from selling a bond early or there's a wide range of things that could happen along the way. Generally, I wouldn't worry about it too much if the numbers are relatively small. Walmart put up about $600 billion in revenue. So if the number was like 60 or $100 billion, yeah, let's go find out. By the way, if you go to the actual income statement on their annual report, well, you can find all the information we need over there in the footnotes of their income statement. But generally, with most companies, the vast majority of companies, looking at these key numbers would be the most important numbers to look at and the most important numbers to pay attention to. Okay, so now we're at income before tax. That gets split into two different numbers. Profit, also known as net income, and then taxes paid. Now we can see with their tax expense, they paid about $5.5 billion in taxes. And we can see in parentheses, it's showing up as just under 1%. But it's real important to remember that companies do not pay taxes on revenue. They pay taxes on profit. That 0.1% is relative to revenue. But they actually pay taxes on the income before taxes number. So if we were to take their $5.5 billion in income tax and we were to compare that to the income before tax, 5.5 billion divided by about their $21 billion number, we can see their tax rate's about 25%. So if you ever read about a company, what their company tax rate is, compare those two numbers. In this case, Walmart, for this particular year, their tax rate is about 25%. Okay, now we have the illustrious net income. So with net income, we're looking at 2.4% profit margins for Walmart. Now, that's about $15 billion, so take that for what it's worth. But when we look at it from a percentage basis, we can answer a lot of questions based on different things that might be happening in the world. So let's imagine that expenses were going to go up on a company like Walmart. We know that they buy a lot of their products from China. Well, let's pretend that tariffs were going to hit all of their products. I know that's not going to happen, but let's just imagine, for simplicity's sake, all of their products are going to get hit by, let's say, a 10% tariff. By the way, if they did start having to pay tariffs, and they're the importer, so the importer is who pays the tariffs. Well, if the importer were to pay the tariffs and Walmart had to pay 10% more, that would end up in cost of goods sold, also known as cost of revenue. Cost of revenue, let's pretend that went up by 10% to account for the 10% tariffs. Well, that 10% of almost $500 billion is almost $50 billion. We see they have about $15 billion in profit. Just like that, they're no longer profitable. This is why, if you've heard anybody say that tariffs are likely to increase inflation, well, the reason why is the only logical move for Walmart is to say, well, since we can't go not profitable, since we only have 2.4% profit margins, well, what we got to do is increase our revenue. So you have to increase the prices to offset for those increased costs. Hence the reason you'd end up with higher inflation. But now, sticking with some important comparison points, how does this entire chart stack up to Target? Well, right away, we can see that net income for Target is a higher percentage. So although they have significantly less from a dollar amount, this is why the percentages are so useful. Although they have significantly less from a dollar amount, from a percentage basis, they're at 3.9%, which tells us they are a more profitable company. Even when we look at tax expense relative to income before tax, well, they pay about, or at least in this year, they paid about 22% taxes versus Walmart's 25% taxes. So again, that's a benefit to Target shareholders. Now, if I'm considering investing in this industry and perhaps I'm going through looking at some different companies, using this chart alone could tell me right off the bat, I prefer Target over Walmart right now. And then we can start accounting for some other things like growth and expected future profit margins, things like that. But everything you see here are the most important components to the income statement. Next, in this series where we're going through the different financial statements, we're going to look at both the the cash flow statement and the balance sheet. Now, if you'd like to sign up to get access to the Investors Grow website, where we have all this over there to analyze global companies around the world, I'll leave a link to that in the description below, link over there. If you'd like to learn how to analyze companies, we did a video called 8 Steps to Analyze a Stock. Link right there. Also a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.